On your marks, get set, invest. Calm down, please calm down, okay? I'll get this sorted out for you, okay? I promise. Oh, hello there. These overexcited little dudes are all in a bit of a tizzy-whiz about where to find good investments. Now, in our previous videos, we've looked closely at what makes a good investment, when to buy, when to sell, how to manage your risk level. But where do you actually find the hidden gems in the first place? Well, that's where this guy comes in, our reliable buddy, the social media tipster. So tell us, what's going to go to the moon? Buy GameSplat! Guaranteed 1000% price rise by next Monday, latest. Buy it now. You need to buy it now, right now. Any later than now will be too late. Okay, now let's get serious. A good place to start is with what you see around you and what you know. That clothing store you like, is it becoming more popular? Are your friends talking about it? So that could be a good share to research. How about the pub on your high street? Does it seem popular, good value, and a nice place to hang out? If it's part of a chain, then that could be worth investigating too. When you're reading a company's financial results, it's a lot easier if you can understand what it is the company actually does. If it's involved in some obscure area of biotech research and you're not a sciencey person, then you may struggle to understand a lot of what you're reading. That doesn't mean you can't learn to understand it though. Some investors make it their mission to become experts on one particular area, such as, say, energy shares or biotech shares, and then they're in a great position to decide which companies look most promising. Online, there's an almost endless supply of information and opinion about different shares. On social media, a lot of the chatter can be very misleading, sometimes downright scammy, but there is lots of informed opinion on reputable news and financial sites. We'll start with the big news websites. You know the ones. Some of them still even have those actual big papery things that you can buy in physical shops too. These news websites tend to have business and money sections with lots of articles and research into different companies. Often the journalists will recommend certain shares that they think may climb higher. This can be a good starting point for your own research, based on all the principles and the techniques that we've outlined in our other videos. I'll remind you later on in this episode about how to do that research. Now, don't worry if you don't agree with a journalist's conclusions about a company's future. I used to be a TV business reporter, remember? So take it from me, they really don't know everything. They get stuff wrong sometimes. Trust your own research more than someone else's. But at least their research can be a good jumping off point for you. ShareSoc would like to remind you that whenever you rely on someone else's research or tip, then that's a high-risk strategy. DYOR, do your own research. Now, as well as newspapers, you'll find plenty of research in specialist magazines. These mags and websites are packed full of analysis of different shares, so if you're stuck for ideas, they can be very useful. There are lots of websites offering analysis, but they do vary enormously in quality, so please be careful out there on the wild web. Here are some of the more reputable ones. There are also some paid services that go into even more depth with their research. And for looking at charts, there are sites that specialize in offering free or paid subscriptions with extra features. There are also lots and lots of investment podcasts these days. Again, quality varies, but they're generally of higher quality, at least, than the investing tips videos that you'll find in huge numbers on certain popular video sharing sites. And if you push aside those tipster videos, you can often find useful interviews with the CEOs of companies and fund managers too. Some websites also analyze funds as well as individual shares. These sites focus very closely on funds. They have information about nearly every single fund out there. You won't run short of investment ideas on those sites. And lastly, the platforms you signed up with to buy shares and funds will usually have lots of their own research and articles. Again, the platform's own analysts will have their own opinions about whether something's a good buy or not. Ultimately, you do need to make your own decisions, though. Don't just rely on someone else's view. So you've done all your research, you've identified all sorts of different investments that you think will be winners. Now it's time for a trial run. Each of you will run a demo account, like the one that we looked at in the previous episode, using pretend money. You need to think once again about what you want to achieve financially. Okay, so low risk says the goal is a long-term regular income. So you've picked a fund that pays regular dividends. That's sensible. Where are you going? You can't just pick that one fund and nothing else. If you put all your eggs in one basket, that's not low risk. Low risk. What if the fund manager performs really badly? It does happen sometimes. You need diversification. So how about those shares in Utility PLC? The share price chart is nothing to write home about. It just kind of meanders along. But the dividend is nice. 6% a year. So even if the share price goes nowhere, you still get 6% of the amount that you paid for the shares per year. And the company is heavily regulated and subsidized by the government, so it's unlikely to encounter any serious problems. That's still not really quite enough diversification, though. I think you should probably pick another couple of low-risk funds while you're at it, and maybe a few more low-risk shares too. Don't just go for share funds, go for a mix of government bonds too, as they're often classed as low risk. You'll get a regular income from those bond funds too. Your platform may even have a scale telling you how risky they consider each fund to be. Now, medium risk. Let's see what you've chosen. Okay, so you've picked a share called Cash Cow PLC. The share price performance doesn't inspire much confidence though, so why did you choose it? Aha, a big dividend. The company has announced a positive outlook for the future and it has lots of cash on hand. So you're thinking that it will continue to pay those dividends and therefore it's unlikely that the share price will fall too much further. And if you reinvested those dividends, then this is what your actual investment returns from Cash Cow PLC would look like. Very clever, medium risk. I like your thinking. So what else have you picked then? A US equities fund containing lots of different shares. Okay, well, as I said to low risk, you may want more than one fund, as you never know whether the manager will turn out to be a bit of an underperforming dud. And also, all your eggs will be in the American basket, so maybe get a couple of funds covering shares in different parts of the world, and also a bond fund too, perhaps. You don't want all your money in shares and share funds in case the global stock markets crash. Now, what about you, high risk? Okay, technology shares, biotech shares, high growth, very few dividends to be seen here. You absolutely sure that you don't want to mix it up a little bit with, I don't know, a few high dividend paying shares? Or are you determined to stick with these fast growing shares instead? Okay, high risk wants to go for it, but don't forget everything you've learned about when to sell. If you think any of your shares are really going off the rails, just don't be afraid to get out. Right, well, we're all sorted now, so come back in 6 months and show us how your investments have done. Well, it's been 6 months, and I'm still wearing the same shirt. So how have all your investments been doing anyway? You don't know. You haven't been looking at your investments. Oh, low risk. You know what that means? That means you've been engaging in high risk behavior. If you don't look at your investments, you can't make sure you ditch any disastrous ones. And look, Utility PLC, your supposedly safe dividend stock, has plummeted in value as it turned out that the finance director was fiddling the books. If you've been checking regularly, then you could have ditched the share at the first sign of trouble, but now it's fallen a long way and you've lost most of your investment. But don't worry, low risk. Luckily, you were diversified with all those funds you bought. So even though you've lost most of the money that you put into Utility PLC, that only actually represents a few % of your total portfolio. So it's not that big a deal in the grand scheme of things. Now, how about you, medium risk? I see that Cash Cow PLC has reduced its dividend. Does that bother you? Okay. So you're making profit from the rising share price and the company's not going pear-shaped. It simply decided to invest more of its profits into future growth rather than paying such a big dividend. Okay, fair enough. And high risk? How's it been going for you? Right, I see. So it's been a crazy roller coaster ride. Well, you did insist on all high risk investments. So you've been making tons of profit, then losing loads, up and down, but the overall performance has been positive so far. Okay, you've swapped some investments for others, and you've rebalanced your portfolio too. Nice work, high risk. I'm impressed. So I'd say that was a pretty successful trial run. Are you ready to invest then? Wait. Before you get started, let's just go over everything you've learned in all these videos. So head over to episode 10 for the grand finale.